Good morning, everybody. It's just about 10 a.m. on the 12th of, there it goes, 10 a.m. on the 12th of April. Good to see everybody. Happy Tuesday. We have the webinar topics, as always, to talk about today. And we're going to go over some Slott updates for a few minutes. I'm going to talk about the markets, and I'm going to give you some financial planning updates. Today's financial planning update is our investment strategy update. Now, on this webinar, I'm not going to be able to be specific as far as what securities we're implementing into the strategies, but I'm going to do a follow-up webinar just for clients where I'll be able to be specific about what the details of what we're exchanging, the reason why we're exchanging them, and how we're going to move forward during the next period of time, whatever that's going to look like. We're not capricious about changing our investment strategies. So I expect them to stay put for some time. We do review them on an ongoing basis, of course, but we don't like to make drastic changes unless needed. And I believe they're needed right now. All right. So I see people piling in. So just raise your hand if you can hear me and see me okay. Press the raise hand button on the bottom of your screen. Perfect. Thank you. Okay. So you should have all received an invitation now. In just about 2 weeks, we have David McKnight joining us live at the Newtown Theater in Newtown. I know many of you have already signed up. If you haven't, please do if you plan on attending, because the theater the theater will hold about 200 people, but we probably want to cap it at about 100 people just for comfort. But and we're getting pretty close to that number. So if you have an interest in coming and you're listening to this webinar, you can bring a guest if you'd like. You can bring friends who you think would benefit from it. It'll be a good time. The food will be great. The presentation, of course, will be great. And I think you'll get a lot out of it. And it's a wonderful venue. So if you haven't experienced it before, I hope you'll enjoy it. The VIP event for you folks starts at 5 o'clock and goes until 6. And then the program itself goes from 6:30 to 8. Okay, so I've talked about the office. The office is done. There always seems to be small little things to do. I had the contractor back in last week. He's got to come back for something else. But other than that, it's overall done. But the first floor is certainly up and running. So we're having live meetings. We're able to drop things off, pick things up. So it's really nice to have things back to normal that way. We talked about the changes in investment models being complete. We're going to begin reallocations very, very soon. We have a new trading platform that we're working through. So once we're very confident in that trading platform, you'll start seeing the trades. And as I said, we're going to go over investment changes for the Q2 of 2022, and then that should last some time until there's another reason to change. I'm sorry, I didn't mention the general housekeeping. So I want to remind you all that, of course, this is recorded. You hear that notice when you log in. If you have questions at the bottom of the screen, there should be a Q&A button. You can hit that button, press that button, click on it with your mouse or whatever you're using and type in your question as we go. Chat should be disabled. So the big headline today, of course, is Consumer Price Index. Here we go again. Highest that we've seen, I've seen, that we've seen in 40 years. I certainly wasn't paying attention to it 40 years ago, but 8.5%. So 8.5% inflation. About 2% of that is made up of food and fuel. It's a little bit lower here in the Mid-Atlantic region. So I'm just looking up at the BLS report here on my other screen. And the Mid-Atlantic region is 7.3, it looks like. So just food at home in our area is 11.5. It's the US city average is 10. We're experiencing that everywhere. I think I had mentioned, and if I didn't mention on the webinar, I mentioned it at least in a couple conversations I had that, my daughter and I went to the store just to get snacks, and there were two, small bags, and I think it was $40 or $50. It's just it's very challenging. So I talked to you about my concerns about, this inflation, inverted yield curve. I showed you what that meant last week, and my concerns about recession. and our investment philosophy is centered around those items. So we'll talk more about that. So consumer price index, another big topic. So 8.5% year over year. So that's looking at this time last year compared to this year, 8.5%. That's of course an unsustainable number. The futures are up today and the markets are up the last time I looked today. And the feeling is that this may be a top of the inflation. For crying out loud, let's hope so. When we start to go down from here, the concern that I have, and I've shared with you, is that the Fed only has so many, they can only act so quickly. We've had a very troubling market over the past, since the first of the year, and they certainly don't want to make it worse, and acting too quickly can do that. All right, so let me just check in and see if we have any. Okay, so I'm going to move into the Ed Slott updates. I'm going to share my screen here because I was told that makes it a little easier for you folks to follow along. What I'm sharing are my notes. So I tried to put it in a PowerPoint as I explained to you, but it was just too many slides. So I'm going to share my notes and I'm going to try to remember to turn them off when I'm done, but there's no client information in here or anything like that, but you'll just witness my notes if I forget to turn them off. So, all right. So you should see something now that says, that talks about this week's article, and that's 5 takeaways from the new Secure Act. Yes, last week I did updates to the Secure Act 2.0 that was voted on a few weeks ago, and this is the 5 takeaways from the new Secure Act. This is from Sarah Brenner. You all met Sarah probably about a month ago now, when she joined us to talk about naming trusts as beneficiaries. So raise your hand if you can see that on my screen. Thank you, everybody. All right, so you can read along here, but Sarah's talking about the Secure Act was signed into law. This is the original Secure Act was signed into law in late December 2019. The new law upended the rules for retirement accounts. This is where we lost stretch IRAs for most people, and changed in a positive way, changed the required minimum distribution from 70.5 to 72. But with it came new questions, and the IRS guidance was eagerly anticipated. Finally, on February 23rd, the IRS released new proposed regulations that incorporate all the changes brought about by the Secure Act. Since then, we've been busy combing through 275 pages of complicated new rules. As the dust begins to settle, here are 5 takeaways from the new Secure Act regulations. So this is not Secure Act 2.0, which is making its way, through Congress as a whole, but this is the Secure Act that started in 2019. So now here we are, February, 2 years later, they finally give us some regulations around this. So this is one of the frustrating things about Washington. One of the great things, though, about the Slott group. So these experts are combing through this 275 pages of complicated new rules to help us do a better job for you and to keep us, informed, to be able to answer the difficult questions, because a lot of questions are coming up around this. So I see a couple people raising hands. If you have a question, type in your question, because I can't respond to raised hands. All right, so really, really great that we have that resource. I say we, you, me, and you have this Slott group resource. There's nothing else like that out there that I'm aware of, for sure. And I've been doing this over 20 years. And, all these large firms I worked with in the past, they promised resources like this, but they were just never able to deliver, or especially around tax issues. So the RMD rules, required minimum distribution rules, are more complicated than ever under the Secure Act. When it comes to required minimum distributions, the rules have become more complicated instead of less complicated. Isn't that frustrating, right? So this is one of the most difficult things that are triggered. People are all over the place with the rules. They don't quite understand them. What must I take? Where must I take it from? When must I take it? Many people still have that 70.5 age stuck in their head. Some people now are thinking 75. That's under the new proposed legislation, and it doesn't start for some time. So, currently the RMD is age 72. But these rules have become even more complicated instead of less complicated. I'm right here. We have more kinds of beneficiaries and more distribution options than ever before. It's true that most retirement account beneficiaries are subject to the 10-year rule and are no longer eligible for stretch. That's true for the majority of folks. However, while this may seem to make the rules easier, it doesn't. What the IRS has done in the regulations is simply add the 10-year rules, yet another layer to already complicated rules. What is old is new again. The required beginning date is when RMDs must begin during retirement account owner's lifetime. Prior to the Secure Act, this date played a critical role in determining the options available to the beneficiaries. With the new Secure Act, right, from 2019, it was thought that this date would no longer matter for many beneficiaries. However, the new regulations said, remember, the IRS said, well, it looks like you're going to have to take everything out, or the Secure Act said you're going to have to take everything out of an inherited IRA by the 10th year, the end of the 10th year. And then the IRS came out with a letter that said, well, no, you had to take required minimum distributions through that 10 years. And then a few months after that, they backed off of that and said, we were wrong in that memo. It has to be withdrawn within 10 years. The new regulations that they just came out with, though, reinstituted that RMD requirement within those 10 years. So they're really all over the place. So what is old? I'm up here. What is old is new again. The new regulations resurrect the importance of this date by requiring annual required minimum distributions be taken by beneficiaries during the Secure Act's 10-year period, only when the account owner dies on or after the required beginning date. So not for everybody, but only for those folks who have to or have already began taking required minimum distributions. So yes, it makes it more complicated. Excuse me. So Roth IRAs are even more attractive. One, to avoid the complication of annual RMDs during the 10-year period, the Roth IRA is the answer, Sarah writes. Roth IRA beneficiaries are always considered to have died before their required beginning date and are never subject to annual RMDs during the 10-year period under the Secure Act. What is not to like about inherited and Roth IRA and letting it sit and grow tax-free for 10 years? That's a huge advantage for Roth IRAs. Just another thing that makes the Roth more attractive for most people than a traditional IRA. And Sarah writes, think twice before naming a trust as an IRA beneficiary. We talked about this for an hour a few weeks ago. So if you missed that webinar, you can go to outerboroughwealth.com and go into webinars and events, and you'll find special webinars, and you'll see Sarah's webinar with me there. The rules that apply when a trust is named as an IRA beneficiary have always been complicated. However, the ability to get the stretch was worth it for many. Now, the Secure Act regulations make the rules even more complex, and many trusts will be subject to a 10-year payout anyway. I'm right here. This may mean you should think twice about naming a trust as beneficiary. While there are certainly good reasons for doing so, such as providing for a special needs beneficiary or a minor child, in many cases, leaving an IRA to a trust may not be worth the cost and administrative headaches. And here's where she says, good advice is essential for many individuals. Their retirement account is their biggest asset. This is why this is so important, and why it still blows my mind that there's only 400 of us in the entire country who study with and work with the Ed Slott group and are elite or master elite advisors, part of the advisor group with Ed's group. But good advice is essential for many individuals. The retirement account is their biggest asset and the product of many years of hard work and careful savings. The new regulations make the rules for these accounts even more complicated than ever. One wrong move can result in unnecessary taxes and penalties. To protect your legacy, be sure to consult with a knowledgeable advisor who's up to date on the new rules. Very good. Thank you, Sarah. Inherited IRAs. So moving on to the question, the mailbag. Walter's asking, so I have a question here about what are the penalties if a beneficiary does not empty an inherited Roth within the 10-year period? So Walter, I'd have to actually go back and research that question, but I'm assuming it's going to be similar to the 50% penalty on what should have been removed for the RMD. But if you send me that in an email, I'll get you the answer to that. But good question. Let me dismiss that. Thank you. All right. Inherited IRAs and SEP accounts, today's slot report mailbag. So there were a few questions. I'm only going to read one here or share one. The other ones were just very complicated with very specific questions about specific accounts that don't apply to most people. But this one does. So this is a non-spousal inherited IRA account. So this happens all the time. Children, it could be really anybody, but not a spouse inherited IRA account. Once I take my RMD for the year, am I able to take excess funds and roll these into a Roth account? So I think what the person's asking here is, and I get this question all the time, I have an inherited IRA from my father or brother or whomever, and I want to convert that to a Roth IRA. And that's one of the IRAs that you cannot convert. So you can take distributions, and if you meet the requirements, you can do a contribution to a Roth IRA, but you cannot convert an inherited IRA to a Roth IRA. So here is Andy is the one answering this. So inherited IRAs do not follow all the same rules, nor do they have all the same benefits as your own IRA. For one, inherited IRA dollars are not permitted to be converted to a Roth IRA. This is true even if you have satisfied your RMD for the year on that inherited IRA account. You could use a withdrawal from the inherited IRA to make a contribution to a Roth IRA, assuming you're otherwise eligible to contribute to a Roth, but a conversion is not allowed. So that is a very, very common question I get all the time, and it's one of these confusing rules that people have a hard time keeping track of. All right, so they are the slot reports. I've ended my share. All right, let's get into investments in the market. So for the week ending last week, so that's April 8th, markets were down again, 0.23% for the Dow Jones, down 1.24% for the S&P 500, and down 3.85% for the NASDAQ just for that week. That takes the year-to-date numbers down significantly. So Dow Jones Industrial Average is down 3.94. The S&P 500 is down 5.46, and the NASDAQ is down 12.19. And in fact, there is not a single stock related index that I'm seeing here that is positive for the year. The small company or for world index, right? So for small companies around the world is down the most, 8.5%, other than the NASDAQ, which is down 12. But all over the place, markets are down. And more frustratingly, the bond markets are also down. So the Barclays Aggregate Bond Index, as I shared with you, is probably the most widely used index, and where a lot of the investment in bond funds fall, is down 7.8% for the year. So almost 8% down in bonds alone. That's where it's very frustrating for folks, because often people have the mindset of, well, when my stocks are down, my bonds will be up. And that certainly isn't the case this year for many folks. Master limited partnerships are up significantly, almost 21%. So there are some things out there, and we're going to talk about some of those. Like commodities are up 27%. Energy is up significantly, but the most common investment stocks, bonds, are down both significantly. Okay. Questions. All right, so we're going to talk a little bit about what BlackRock is saying. I thought this was interesting. And BlackRock is writing, scarcity inflation raises growth risks. So they talk about the shocks to supply. So supply shocks have created scarcity inflation, they're calling it, making higher inflation more persistent and increasing the risk of a growth slowdown. So that seems to make sense. We all know everybody knows the term supply chain right now, right? And we all hear about how it's very difficult to get things made. It's very difficult to get people back to work. The employment numbers are better, certainly, than they were a year ago, or probably even 3 months ago, but you're still having issues filling certain jobs. So BlackRock is saying that while we have these shocks to our supply chain and it's difficult to get things, we're of course going to see inflation. The question is, of course, how much of this 8.5% inflation do we attribute to the supply chain, as opposed to some of the other issues we have as far as our monetary policy, just the general health of our economy. If it's really just the supply chain, we should see a leveling off pretty quickly as things get back to normal and people have access to things that they didn't have access to or haven't had access to. But I'm not optimistic in that regard. So the market backdrop, they write, the 10-year U.S. Treasury yields hit 3-year highs after it became clear the Fed will start to reduce its balance sheet quickly. BlackRock sees further yield rates raises ahead, which means that's the dividend amount, if you want to call it that, or interest rate amount, or in bond terms, it's called yield. That's the amount that you receive for your investment in bonds. And as yield rates rise, we'll continue to see drops in bond markets. We could see the European Central Bank officials trying to guide down market expectations for multiple rate hikes this year and next. And then they talk about their investment themes. So their first theme and this isn't in order of importance, but their first theme that they list is living with inflation. We expect central banks to quickly normalize policy with rates rising to historically low levels. We see a higher risk of the Federal Reserve slamming the brakes on the economy as it has struck a hawkish tone. Implication, we prefer equities, stocks over fixed income bonds and overweight inflation-linked bonds. So number 2 they have is cutting through confusion. The Ukraine war has aggravated inflation pressures and has put central banks in a bind. Trying to contain inflation will be costly to growth and employment, and they can't cushion the growth shock. Implication, we have tweaked our risk exposure to favor equities at the expense of credit, which is very similar to bonds. So they're just reiterating their overweight to stock during this time. Navigating net zero. Now, this has to do with net zero is, the kind of the green movement and emissions. So Europeans' drive to wean itself off of Russian gas should reinforce a net zero transition, yet some regions will produce more fossil fuels in the near term as global energy systems are rewired. Implication, we favor developed market equities, stocks over emerging markets. So this is an area where BlackRock is either going to hit it really well or they may falter. It just depends on really what this effect of reduction of fossil fuels around the world is going to be. It's hard for us to determine locally here. We certainly see more electronic vehicles or electric vehicles across the board. I don't know how it's going to work around the globe. I'm a fan. I'm an EV fan for sure. Again, I just don't know how it's going to work across the globe in the short term. I think in 20 years, it's going to be very, maybe even 10. It's going to be mainstream, but we're really looking in a shorter term window here. So Prudential is now in power, and it just a couple interesting points from Robert DeLucia, who I like to follow. He writes, the probability that the Federal Reserve will engineer a soft economic landing is less than 50%. So that's interesting. It's more likely that persistently high inflation will force the Fed to raise its policy rate to prohibitively high levels, ultimately triggering a recession. However, the preconditions for a recession are not currently in place. Although it is inevitable, a recession is not imminent and is unlikely to occur prior to 2023 because of the lengthy time needed for inflation-adjusted policy rates to reach a level that derails the economic expansion. So DeLucia is also saying that the recession is around the corner, that he's putting it that it's unlikely to occur prior to 2023. But my concern, as I've said, is I'm a little worried that the Federal Reserve really has to feather the accelerator on this. And it's very, very delicate. If you don't raise rates fast enough, then we're going to continue to see this higher and higher inflation. And if you raise it too fast, we could really stall the economy and continue to pull down the markets as a whole. So very difficult job, as I've said before. I'm glad I'm not part of the Federal Reserve Board right now. All right, any questions about any of the market commentary? All right, hearing none, let me move on. I'm going to share my screen again, and we are going to talk about our investment updates. Now, again, I want to say that I'm going to be more general here because I cannot share individual securities on a broad basis, right? But from a client point of view, we will be able to have a video that a webinar that is much more specific. So just raise your hand for me if you can see my whiteboard, it says financial planning updates, investment strategies. Okay. Thank you, everyone. So you're going to see me look down as you always do here. Gerard, I don't know if I'm going to have, we're going to talk about that a little bit in this section, not specifically preferred stocks. So Gerard asked, can you touch upon using preferred stocks and dividend stocks? We're going to talk about dividend. You know, I favored dividends for some time, and it's been beneficial. We've always had representation in our ETFs, exchange traded funds, of a dividend focused section. The difficulty always is that you don't want to offset. Whenever you have a dividend focus, you generally give up some growth. So that's the nice thing about account segmentation is, and I'm going to talk about what account segmentation is just as a reminder, but that's the nice thing is that it doesn't mean that you're giving up growth for stability or the help of dividends or absolute return. So good question, Gerard, as always. Let me dig into this and maybe that'll answer your question. So let's talk about the fundamentals here. So of course we have, well, let's see what color we're writing with. Go with green. Of course we have asset allocation. And the changes we're making to our portfolios is exactly that. It's part of asset allocation. So asset allocation, you know, simply is your pie chart or pie charts, how you have your investments spread out among different areas. And we're focusing on a couple different pieces of the pie chart in our changes. But then we have principal protection. So principal protection simply says, how much of the your investment do you want to take out and not have it at risk in the market? And for many folks, it works out well that it's 1/3. So for 1/3 of that, we put it into something that is principal protected. Currently, we use fixed index annuities. In the past, we've used structured CDs. And fixed indexed annuities. The fixed indexed annuities just have the best offerings right now. So we want to take, usually it's 1/3, sometimes it's as much as a half. And the worst that you can do in any given year is 0. Now, we have folks who are ending their year, right, their anniversary year, up slightly in their annuities. Now, if you think about it, usually the principal protect annuities are a proxy for bonds, right? So we use these in addition to or instead of bonds. Well, I just shared with you that the Barclays aggregate index was down about 0.78. So if you could trade being down 0.78 for being at 0, would you take that for the year? You're darn right you would. But you can't live with just 0. So you need some production also. You need some positive growth. And a good average that you should see out of something like this, just from a principal protection point of view, not building in future income, not all those things that can be added to these annuities. I'm just talking about principal protection. Those are bonuses, right? The future income. But we should average around 3 to 5% over time in these, with the worst year being 0. So BlackRock did a great study. I can't share it with the public, unfortunately, but it really showed how having this principal protection buffered and actually significantly helped the growth of a portfolio and average, a total portfolio in normal markets. And in down markets, of course, if you can't do any worse than 0, better to do 0 than negative 7.8. You're never climbing out of a hole, which is nice. And even if it was just 3%, if the average was just 3%, and you're never climbing out of that hole and your stair steps are always positive, while that 3% may not be sexy, right, or exciting, it's just a real kind of solid way to continue to have growth and protect that downside. So I can't say enough about just the strength of principal protection. Now, again, you've heard me say that the majority of people, everybody who manages money for a living does this asset allocation. Many of us also offer principal protection in there because we all see the benefit, or many of us see the benefit. Hardly any of us, unfortunately, do the next thing, and that's account segmentation. And that simply is taking this asset allocation and spreading it out over time. So with the idea that for most folks that we work with, they're coming into retirement or already in retirement, or they're a few years away. But the goal is, instead of just taking this one asset allocated kind of portfolio, and you might have heard of the 60-40 allocation, and hoping that's going to last you for the next 35 years, we understand that we want it here for the rest of your life. You've seen me do this before. And we want to make sure that we have it for the rest of your life, and we have your comfort level covered as well. So we create many allocations for each span of your life. So you've seen this before: 0 to 3 years, for example, 4 to 6 years. This is not for you. This is just an example. 7 to 9 years, 10 to 13 years, and let's call this 13 plus years. And we'll have specific allocations for each one of these segments. And obviously what happens is you're more conservative over here and you're more aggressive over here. And it kind of grows from conservative to aggressive along this timeline. And then as you use these funds here and you use these funds here, this conveyor belts down, right? So it's a lot of work. You've heard me talk about it. It's like driving the plow through the field, pulled by an ox, but it makes the most sense for me. In the pension world where I was brought up, this was called asset liability matching. And it just makes sense on a personal money management and financial planning level, asset liability match. So they're the fundamentals of investments. Now, here's what we're changing with our asset allocation. So again, we're taking this asset allocation as it applies to each one of these segments, right? So we run segment 1, probably all the way to segment 6. Let's just see. 6 being usually legacy longevity. So that's the amount that we identify that you're likely not going to need during your lifetime. So we'll have at least 5-6 different portfolios along that timeline. And that covers most people. We can make a new model portfolio if somebody needs to go out for longer segments, but 5 to 6 covers most people. So we're changing these allocations, or we're adding to these allocations first in total return. So what does that mean? Like Gerard said, I'm looking for things that are going to give us some return. So we know that stocks right now, let's just look at it. Let me just pause this for 1 second. Let me pull up my notes. Give you accurate numbers. Boy, that's big over there. Okay. All right. So stocks right now, resume my share. I told you year to date, the S&P 500 is down 3.94. I'm sorry, that was a Dow. The S&P is down 5.46, and the NASDAQ is down 12.19. So there's a couple things we can do. The first thing that we can do is I've been looking for, and I found an ETF that does covered calls. So covered calls is an option strategy that allows for where you write an option, you receive a premium for the right to purchase the stock at a later time, right? It's all determined on the options calendar. It's a complex structure that not a lot of people do well, and it takes a lot of time. And when I say not a lot of people, there aren't good management companies out there. Eaton Vance used to have a good covered call strategy, but that was many, many years ago, and they're not, as I've been looking, they're not viable right now. So that's not a recommendation. That's just an example. So we have an ETF, right? We want to keep the costs low and keep it efficient with a covered call strategy. So that covered call strategy is yielding at about 7.60% today. That's going to track many of the indices, maybe not the NASDAQ. Let's just circle these two. What I expect is this ETF, exchange traded fund, right? That will, if this line, right, is the S&P 500, and this line, and they move pretty much the same, right, is the Dow Jones Industrial Average. I expect this exchange traded fund that writes covered calls just to smooth this a little bit for us, right? And it has to do with the dividend yield, but it also has to do with the fact that when you write these covered calls, it gives some buffer to the downside. Because if your stock price is at $10 a share and you receive a $1 premium, right, for this option, well, you could your price could drop to $9 a share before you've lost money on that. That's very simple, I know, but it helps buffer that downside and gives us some yield along the way. So that's the first thing. The other thing I wanted to have in this sleeve, this section, right, and we're calling this total return section or sleeve, are, I'm trying really hard not to be specific, but our bonds that are going to, their interest rates are going to rise as inflation, as interest rates rise, right? So it's where it's built in that you've got that float, right? So interest rates go up to 5%. The yield that these bonds are giving also increases as well. So that's going to give us some stability as well. There's a couple issues that invest in private debt that I've been watching, one for many, many years, and well, the other one for a few years as well. And they give us significant yield. So one is at 11.04% right now, and the other is at 7.91. So the thought on this, and it's been proven out, on looking at historical returns, no guarantees, of course, of future returns, is that, again, you're going to have this smoothing effect. So if we just blow this up, by laying over, let's call this green section, the sleeve, it'll first minimize some volatility, but also we're going to have, if we just average, these are pretty high averages, but if we just average a 7% total return on these, that's going to help dramatically when the markets are down. Bond markets are down. It'll give us some return. And then when we look at our allocations across these scenarios, right, these different segments, we range from 10% on the more conservative side to 22% on the more aggressive side, but we bring it down to 0 on our very aggressive sleeve, because I want that segment, I shouldn't have said sleeve, I want that segment to be just the growth segment. That's typically where we use the Vanguard exchange traded funds. I did it anyway, right? So, and we have a growth component in there, and that's money that you're typically not going to use for, during your lifetime at all, but certainly not for 18 plus years. So we don't have to buffer it as much, but the ranges from when you're looking at segment 1, segment 2, segment 3, segment 4, you're going to see a range for this total return sleeve of about 10 to 22%. Right now, there's 3 securities in there that I'm going to share specifically with clients, but not on this call. The second are structured notes. Now, this is an area I'm very excited about. So if you went on my website, you would see many years ago, 2011, I think it was, I was featured in the Wall Street Journal talking about structured CDs. During 2008, 2009, so maybe it was 2010 when this article came out, but during 2008, 2009, I used a lot of structured CDs in our portfolios to really great benefit. So as the markets were falling, these were principal protected CDs that clients were greatly benefiting from. So, and they're issued by banks. So you want to make sure that the issuer is strong, but the idea behind these structured notes are different than the CDs. They don't offer principal protection, but what they offer is a buffer. So I pulled a chart. Let me see if I can find it here. Yeah, it's way down here. I thought I'd be writing more. And this is an example of one. I was very careful not to include the name of the issuer, because what we're doing is we're going to, again, have different durations of maturity of these bonds, giving different segments of the portfolios. So the earliest duration, maturity date will be 1.5 years, and it looks like it's going to go out to 3 years to get some additional return. But what this is showing here is an example. So what it does is it's tied to an index, and in this case, the index is the Dow Jones Industrial Index, the Russell Treasury, I guess, what is RTY? I'm forgetting that, and the S&P 500. RTY may be the Russell 2000. Hold on one second. Russell 2000, yes. So the Russell 2000 are small companies. So we had the Dow Jones Industrial Average, the Russell 2000, and the S&P. So the returns are derived off of these indices, but you have these buffers, and I'm using these in place of the fixed index, the bond funds that are suffering and probably will continue to suffer over some time. So the idea is that in this example, as long as we don't cross simply a negative 30%, you're going to see a positive return, and it pays a coupon. So it's 10% annually, right? That's per annum, paid quarterly. So it's not 10% every 3 months. It's 1/4 of 10%. But the idea here is, again, you're going to have that total return, right? You're going to get this coupon amount, but you're also going to get this buffered amount, this buffered protection, because these, one of these indices would have to be down negative 30% before you experienced any loss. And then you don't catch up all the way to that negative 30. If this is down negative 31%, as an example, you would be down 1%. So while it's not perfect, it's not principal protection, it doesn't have the time commitments of principal protection, because to offer true principal protection, most of the time you have to hold these positions for many years. You can take income out of them and things like that, but for most people, we're holding those for 10 years or more for that principal protection. Tremendous value. So you have risk here, but it's a buffered risk. And I'm looking at an average of negative 30 to negative 40%. So we're going to use issues that are out there. And then we're also working on having a custom issue built just for our clients. And that is the difference between the negative 30 to negative 40. It depends on what index we use. So this is complex, I know. There are, these are fine in retirement accounts, really easy in IRAs and Roth IRAs. In taxable accounts, they're going to be a little more complicated from a tax point of view. With these structured notes, you pay a original issue discount tax along the way. So you're going to be taxed every year that you have this, right? So we've got to manage that. And then with these yields here that we're going back up to with this total return sleeve, when we're talking about 11.04%, 7.9%, let's say an average of 7%, the majority of these are non-qualified dividends, which means they're treated like ordinary income. So understand that there's going to be some tax drawbacks, but I believe that the benefits of buffering the portfolio, adding some total return in difficult times, right? So the markets are down or sideways and we're still getting some positive return, that the tax benefits we can manage that. What we can't manage is what happens with the S&P 500. Does that make sense? So that's the direction of the portfolio. I'm really looking forward to having a more detailed conversation with clients and in a client video. But for where we are right now, I'm going to stop now and just see if we have any questions. Okay, I'm not seeing anything. All right, so we went over, we talked about inflation, 8.5%, not good. We went over some the Slott report and some good questions from the Slott group. We talked about the markets, gave you market updates. We talked about some analyst thought, and then we dug into the financial planning topic today, which is update investment strategies. And this is complex. It's hard to explain in 15 minutes or so. I hope you have a general idea of where we're heading with the addition of these two sleeves, the total return sleeve and the structured note sleeve. Again, the idea is to help buffer this volatility, right? Help smooth this out and help add some return, even if we add 5, to 6% return in difficult markets, that's a home run. It's not perfect. Of course, there's still risk. In that example I showed you, if the index, one of the indices is down 30%, you trigger that downward movement. You don't get the coupon for that period of time, and you have some risk. So for example, again, if the index is down 31%, you would be down 1% during that time. So it's not principal protection. We hopefully have already gotten that taken care of here, right? In this principal protected section here. It's not principal protection, it's buffer with some significant coupon, right? Some yield. So I hope that all makes sense, folks. If you have questions, reach out, send me an email. If you're a client, you should start seeing these changes soon. I'm not going to have a video this week, unfortunately, but hopefully early next week, I'll have a client video or a client webinar where we can discuss this in detail, and then we'll have a video to release. But I hope everyone has a great week, and I hope to see you soon. Take care.